Let me tell you exactly why 99% of people will miss the biggest wealth transfer that XRP is about to trigger, and I want to be very specific about this, not vague, not motivational, specific, because the data tells a story that is more uncomfortable and more important than any price prediction you have heard this week. The wealth transfer I'm talking about is not coming from XRP going to some astronomical price. It is already happening, right now, today, while the price sits at $1.41. While the headlines scream about the Fed decision and the Clarity Act delay and the whale dumps, while 99% of people who will ever hear about XRP are either not paying attention or paying attention to the wrong things, and the people who lose in a wealth transfer are never the people who did not have enough money. They are the people who had enough money but did not understand the mechanism. Stay with me, because I am going to show you the mechanism completely, honestly, step by step. The first thing you need to understand is what a wealth transfer actually is. It is not a price going up. It is a price going up while some people are holding and other people are not. The price going up is neutral. The wealth transfer is the gap between the people who are positioned before the move and the people who try to position during or after it. And here is the critical data point that tells you exactly where that gap currently is for XRP. XRP ETFs absorbed $1.3 billion in just 50 days since launching in mid-November 2025. 43 consecutive trading days of net positive inflows before hitting the first zero inflow day on December 26th. No outflow days, no redemption spikes, just steady accumulation through volatile December markets. This signals institutional mandates completing, not retail speculation chasing momentum. The issuer lineup explains the staying power. Canary Capital, Grayscale, Bitwise, Franklin Templeton, and 21 shares serve pension funds, endowments, and sovereign wealth entities that conduct months of due diligence before committing capital. Find bold? Pension funds, endowments, sovereign wealth entities. These are not day traders. These are institutions that manage multi-generational wealth for universities, governments, and corporations. They spent months in due diligence before committing a single dollar. They moved $1.3 billion into XRP ETFs in 50 days. And then they kept moving money in, steadily, quietly, without a single day of redemptions, while XRP's price was falling 44% from its January peak. That is the mechanism. That is the wealth transfer in its early phase. Retail investors watching a falling price and concluding the story is over. Institutional investors watching the same falling price and concluding the accumulation window is open. Retail sold while institutions bought, creating a gap that rarely persists long. Finbold, a gap that rarely persists long. That is the sentence that every XRP holder needs to read twice, because it describes exactly what happens in every major wealth transfer in financial history. The gap between what the asset is priced at and what it is worth based on its fundamentals. The gap between what retail sees, a price chart going down, and what institutions see, a supply-demand imbalance that only resolves one way. And the gap closes, not gradually, not smoothly. It closes in a move that most people either miss entirely or catch only the tail end of. Now here is the specific data that tells you why 2026 is the year this particular gap closes. XRP's ODL service has processed over $15 billion in 2024. ETF-driven supply absorption has locked 746 million XRP in custody with minimal redemptions. If inflows continue at the current average of $27.7 million daily, XRP ETFs could reach $5 billion by mid-2026, locking an additional 2.6 billion tokens into custody, representing 4% of total supply. Crypto news, 4% of total supply locked into ETF custody, on top of the 55% decline in exchange-held XRP since October 2025, on top of the 32% of circulating supply now held by whale accumulation wallets. You are looking at a market where the available floating supply, the XRP that can actually be bought and sold in the open market, is shrinking at exactly the same time that institutional demand is growing. Ripple operates under a structured escrow system, unlocking 1 billion XRP monthly while relocking 60 to 80% of the released tokens, effectively capping market liquidity expansion. As of late 2025, approximately 35 to 38 billion XRP remain in escrow. A $500 million institutional allocation could move XRP's price 5 to 10%, whereas the same inflow would barely register on Bitcoin's scale. CoinDCX, $500 million moves XRP 5 to 10%. Bitcoin barely flinches at the same amount. This is the market cap asymmetry that most people who compare XRP to Bitcoin miss entirely. XRP's smaller market cap means that institutional capital flows have a disproportionate price impact. when the pension funds and sovereign wealth entities that are currently building their mandated XRP ETF positions complete their initial allocations and start their second round, or when new institutional mandates get approved adding fresh capital to the XRP ETF ecosystem, the price impact is not linear. It is exponential relative to the dollar amount because the available floating supply is thin and getting thinner. Now let us talk about what 99% of people are actually doing while this mechanism is building. Because the behavior pattern is as consistent as the data. They are waiting for confirmation. They want to see XRP break $2 before they add. They want to see the Clarity Act passed before they buy more. They want the Fed to cut rates before they feel comfortable holding risk assets. They want Bitcoin to get back above 100,000 before they believe the altcoin cycle is real. They want certainty. And certainty in financial markets always arrives at the same time as the price that makes the entry too expensive to justify. XRP presents a compelling asymmetric opportunity for 2026. The downside appears contained around $1.50 to $1.80 levels, where technical support, ETF accumulation, and whale buying converge. For investors seeking exposure to blockchain infrastructure with tangible enterprise adoption and near-term catalysts, XRP offers one of the highest conviction opportunities in crypto markets. Coin central asymmetric, that is the word. The downside is contained by a floor of institutional ETF buyers who have shown 43 consecutive days of buying without a single day of redemption. The upside is not contained because the institutional adoption story that is driving those ETF flows is still in its earliest phase. Analysts project a $5 to $14 price range if ETF inflows hit $10 billion, balancing short-term bearish signals with long-term structural bull case. Crypto briefing, $5 to $14 from $1.41. Under a scenario, $10 billion in ETF inflows, that is not a fantasy. It is the natural continuation of a trajectory that has already accumulated $1.3 billion in its first 50 days. If ETF inflows at the current rate of $27.7 million per day continue for the rest of 2026, the total would exceed $10 billion before year-end. Not a bull case, not an optimistic projection, a mathematical extension of the trend that is already in place. Over 300 financial institutions, including Santander, American Express, and MoneyGram, have integrated XRP into their systems to streamline international transfers. These institutions leverage XRP as a bridge asset, converting local fiat to XRP for instant settlement and then back to the recipient's currency. Benzinga, 300 institutions, already integrated, already using XRP for real transactions, not pilot programs, not research papers. Live production deployments, processing real money for real businesses right now. And the Digital Asset Market Clarity Act has provided a framework for classifying digital assets, offering institutions greater confidence in allocating to XRP and reducing legal risks for large-scale institutional adoption. Changely legal risks reduced, regulatory framework established, 300 institutions already integrated. Goldman Sachs, the largest ETF holder. Pension funds and sovereign wealth entities building mandated positions. Supply shrinking on exchanges. ETFs locking up more tokens every single day. This is what the wealth transfer looks like before it becomes obvious. And the reason 99% of people will miss it is not because they lack the information. It is because they cannot hold the discomfort of being in a position that has not yet been confirmed by price action. The price is not confirming the fundamental story yet. It will. Gaps between institutional accumulation and price always close. But the closure does not wait for retail comfort. It happens when it happens. And the people who are already positioned are the ones who benefit. Here's the honest risk picture, because every analysis that protects you includes it. Macroeconomic conditions present additional risk. A 2026 recession, Federal Reserve policy tightening, or crypto winter could compress risk appetite across digital assets regardless of fundamentals. XRP's high correlation to broader crypto markets means it would likely decline alongside Bitcoin and Ethereum in a sustained bear market, potentially overwhelming positive idiosyncratic catalysts. Ripple's monthly escrow releases create ongoing supply pressure that could cap upside or trigger corrections that shake out momentum buyers. Coin central. These risks are real. A hawkish Fed, which tomorrow's dot plot could signal, compresses risk assets. A recession compresses all crypto simultaneously. Escrow releases add monthly supply pressure that requires sustained institutional demand to absorb. The $1.11 floor, if broken, takes the bullish structure off the table until proven otherwise. These are the scenarios where the wealth transfer gets delayed, not canceled. Because the institutional infrastructure, the ETF products, the regulatory clarity, the ODL corridors, the 300 integrated institutions, does not disappear in a macro downturn. It waits, And when the macro headwind reverses, the fundamental supply-demand imbalance that was building through the difficult period suddenly has a clear runway. The 99% who miss the wealth transfer will miss it in one of three ways. Some will never position because they wait for certainty that arrives too late. Some will position and then panic sell during the macro volatility that precedes the move. And some will position correctly, but with too small an allocation, psychologically unable to hold meaningful size through the discomfort of a falling price, even when the data says the floor is held by institutional mandates. The 1% who win will be the people who understand the mechanism, not just the price target, who see the 43 consecutive days of institutional inflows not as a footnote, but as the most important signal in the XRP market, who understand that when Goldman Sachs, Franklin Templeton, and sovereign wealth entities are building mandated positions while retail is selling, the gap between those two behaviors is where the wealth transfer originates. Large addresses are aggressively accumulating XRP during the current consolidation phase, leveraging this period to build massive positions and anticipating the institutional breakout of late 2026. Light finance. The consolidation phase. That is what the current price action is, not a failure of the XRP thesis. A consolidation that is building the compressed spring that releases when the macro headwinds reverse, when the Clarity Act passes, when the Fed pivots, when one more institutional mandate gets approved, and the ETF flow accelerates past the threshold that forces a price re-rating. The biggest wealth transfers in history always look the same before they happen. The asset has genuine utility. The institutions are quietly accumulating. The retail community is frustrated by price action that does not reflect the fundamental story. And then one catalyst, one confirmation that the gap between price and fundamental value has become too large to ignore, triggers the repricing that moves the asset from the hands of the impatient to the wealth of the patient. 99% will miss it because they are watching the price. The 1% who win will be watching the mechanism. If this breakdown gave you the clearest possible picture of where the XRP wealth transfer is in its development right now, hit the like button so more holders can access this kind of analysis. Subscribe to stay updated as the institutional flow data develops through 2026 and the gap between institutional accumulation and price begins to close. And drop your honest answer in the comments right now. Are you in the 1% watching the mechanism or the 99% watching the price? Because that question tells you everything about whether you are positioned for what comes next. Stay informed, stay patient. The gap always closes. The only question is whether you are on the right side when it does.